All right, let's jump straight into this explainer and follow the absolutely wild journey of a single dollar through the launch of a brand new bakery. We're going to trace exactly how money moves, morphs, and multiplies, using the story of a small startup to really decode the financial systems that run literally every successful business in the world. We're ditching the dry, textbook definitions today and starting with a fascinating mystery about the secret life of ingredients. Just think about it for a second. How does a simple, boring bag of flour sitting on a pantry shelf magically transform into a living, breathing business expense? The answer to that question is honestly the foundational key to understanding how your accounting system actually works.
So, our story kicks off with two friends who decide to test their entrepreneurial dreams. And they play it smart. They don't rush into some massive, expensive lease. Instead, they start by hosting baking workshops and selling treats in a small, shared space. They've got incredible energy and this really unique idea for an animal-themed bakery. But to make this dream sustainable, they absolutely have to track everything perfectly right from day one.
And this perfectly captures the double life of inventory. Before it's sold, your flour is a highly valuable asset parked safely on your balance sheet. But the exact moment a customer buys that animal-shaped cookie, boom, that inventory instantly transforms. It moves off the balance sheet and straight onto the income statement as cost of goods sold, or COGS. It becomes an expense tied directly to that one specific sale.
Now, as we all know, ingredient prices are constantly fluctuating. So to keep their tracking super simple without pulling their hair out over complex price changes, our founders used the FIFO method. FIFO just stands for first in, first out. It's wonderfully clean logic. We just assume the very first ingredients our bakers buy are the very first ones they use. No headaches, just a straightforward way to value what's moving out of the pantry.
Okay, here is where it gets fun. Their first major win. They bring in $90 in cold, hard cash from their weekday and weekend baking rental events. People are literally paying to come in and use the space to bake. They pull in $50 from weekday workshops and $40 from weekend gatherings. There are no IOUs, no weird credit terms, just $90 of pure cash collected right at the door.
Let's update the scorecard, or as the pros call it, the balance sheet, so we can see how this affects their overall standing. Before they made a single dime, they had $50 in equipment, $30 in improvements, and $10 in inventory. Now we add that $90 in new cash. Notice how the total assets perfectly balance against their $25 loan liability and their new $155 in owner equity. Both sides total exactly $180. This is the beautiful underlying math humming away behind the scenes in software like QuickBooks. Zooming in on performance, the income statement is showing a flawless $90 gross profit. Why? Well, because they haven't actually used any of their baking ingredients for these rental events yet. The customers are just renting the space and the experience. So for now, that $90 in revenue is pure gross profit with absolutely zero expenses attached to it. But, eventually people get hungry. Things get real, and customers at these events start buying actual physical baked goods, cupcakes, cookies, and those signature animal-themed pastries. They sell $20 worth of treats. This is the exact moment that $10 worth of stored inventory, the flour, the sugar, the eggs, finally gets used up to make those products. So the really crucial point here is how these different revenue streams combine into a total $100 profit. The massive $90 slice is entirely from space rentals, while the smaller $10 slice represents the gross profit from selling $20 worth of pastries minus the $10 cost of goods sold for the ingredients. Two completely different income streams, one big total profit pool. Going back to the scorecard for a second, let's see how this builds, because their new profit flows directly into owner equity. Cash jumps up to $110, but remember, inventory drops to zero because they used it all. So total assets climb to $190. Over on the liability and equity side, that total $100 profit we just talked about gets absorbed straight into equity, pushing both sides of our grand equation up to a perfectly balanced $190. The whole financial system is incredibly connected. But hey, it's a bakery, right? Just when they're celebrating, reality hits hard. Things get messy after a busy event, forcing them to immediately spend $10 on cleaning supplies. They didn't buy a long-term asset here. They bought soap and sponges that get used right away to scrub the floors. That means this $10 isn't an asset. It hits the books as an immediate, everyday expense. We can literally see this waterfall effect playing out on the income statement. We start at step 1 with $110 in total sales. Moving to step 2, we subtract the cost of the ingredients, our $10 COGS, to arrive at our $100 gross profit.
Finally, in step 3, we subtract that $10 cleaning expense we just talked about to land at a $90 net profit. That right there is the true bottom line. Now, let's talk about human behavior, because that introduces some tricky IOUs into our story, starting with accounts receivable. Let's say a customer forgets their wallet but promises to pay next week. The amazing thing about accounting is that you still record that revenue today. This creates an asset called accounts receivable, which lets you recognize the sale even when the physical cash hasn't actually arrived in your bank account yet. It's kind of like accounting magic.
Flip that scenario around. If our busy bakers grab supplies from a vendor but promise to pay them later, they create accounts payable. This is a liability representing money they owe in the future. They get the full benefit of the supplies right now, but the cash will leave their checking account at a later date. But here's the ultimate plot twist. What happens when that customer who forgot their wallet completely ghosts them? That expected cash just evaporates, and you can't just leave a fake asset sitting on your balance sheet. You have to remove it. That lost money instantly becomes an immediate bad debt expense, hurting your profit, because the cash you expected is simply gone. Poof.
Through all the chaos, the twists, and the messy realities of running a bakery, the ultimate accounting equation will always reliably hold true. Assets equal liabilities plus equity. Whether you're turning raw flour into an expense, taking on a vendor liability, or taking a hit from a bad debt, every single transaction adjusts the scales so that they remain in perfect harmony. It is quite literally the unbreakable law of business physics. Which brings us to one final provocative mystery to chew on before our next explainer. If our bakery made exactly $90 in net profit on paper, why does their actual cash in the bank rarely match that number perfectly? Think about the timing of those IOUs we talked about, the inventory sitting on shelves, and the loans. The answer lies in the cash flow statement, and honestly, it just might change the way you look at business forever. See you next time.